everyone. Thanks for coming. I'm Nick Hodge. I'm the founder of the Outsider Club. It is a free daily retail-focused newsletter, sector agnostic. We cover really all facets of the market. And in my spare time, I own and help run a site called Resource Stock Digest. That site's entirely free. We conduct interviews with management teams and resource companies that we like and we believe have a story to tell. So you can go there and get insightful interviews with management whenever the companies that are sponsors of that website have news. I'll get you out of here on time. I know we're starting about 5 or 10 minutes late, but I'll get you out of here on time for a noon lunch. And we're talking today about keeping calm and buying gold stocks. And that's sort of a double entendre, the reason I named it that. One, for days like today when you wake up and gold is down $6 and some of your favorite companies are getting whacked a bit, well, just keep calm and buy gold stocks. And the other meaning of that is sort of some of the volatility we've seen so far in October, where you have 600 or 800 point down days with the Dow Jones Industrial Average. And we'll talk about sort of gold's response to that as we go, but keep calm and buy gold stocks. This is sort of a brief outline, I think, of what I'm going to try to cover today. I'll talk about why so cheap while we're on this slide, and then we'll get to why gold is still a fear trade. A bit about money flows in funds and things like that point to perhaps a contrarian trade evolving in gold. And then I'll just talk to you about a couple stocks that I own and recommend in my newsletters. So why is gold so cheap? Well, I mean, you guys understand why gold is so cheap, or you wouldn't be here looking for investment opportunities. We've had a decade of unprecedented monetary policy. We've had extremely low low interest rate environment that have allowed stocks to go up hundreds of percent in the past 10 years. And so there's really been no need or desire from mainstream investors and funds and institutions to invest in the yellow metal. It's been called a pet rock. You've seen this quote by Warren Buffett and echoed by many other influential people in the mainstream financial sector, as I would call it. And it's just completely unloved. There's really no appetite for gold at the current moment. So this is where we are for the year, and normally I talk about uranium, but this isn't a uranium thing. So I put a chart of GDX and the Gold Bugs Index XUA up against uranium, and so you can't even pick out which one is uranium there because they're all really, really unloved. Down 20-25% for the year, and so that gets my contrarian juices flowing just a bit. So this is some of that unloved sentiment I'm talking about in the mainstream. This is downtown Josh Brown. I don't know if you guys are Twitter folks, but this guy calls himself the chairman of the Twitter finance universe. He's daily or weekly speaker on CNBC, really big in the markets, tens of thousands of followers. And he says back in September, there's no gold in our asset allocation because gold doesn't hedge and diversification works fine without it. This is one of the thought leaders of the mainstream financial world. And this is Max Kaiser, who kind of used to be a gold bug, but now he's really, he actually got kicked off U.S. networks. He's got to have his show on Russia Today, but now he's really big into crypto. And he tweeted the other day, does anyone even remember gold with the flashy memory eraser from Men in Black? You guys remember. So this is just anecdotal, right? I'm not a stock analyst. I'm not a credit analyst. I'm not a geologist. I'm just a guy who has been investing for 10 years, who tries to identify trends and invest in good companies with good teams when those trends develop. And when I see stuff like this, it tells me that gold's time is starting to come. And if you remember, downtown Josh Brown said that gold doesn't act as a hedge, but when mayhem broke loose in the market, this is an October chart of the S&P relative to gold prices and the XAU index. Well, when this month, when the market is down 8 to 10%, look what gold is doing. It is still very much a hedge. It is still very much insulation. It is still very much an insurance policy. It just is. So yes, gold does respond to volatility. Now I'm going to make you read because I'm not a chart guy either, so I got a lot of text. I won't apologize for that. So gold responds to volatility, but also we're seeing some big money start to think about it not just as a hedge, but as an investment. So this is Resource Capital Fund's Josh Peril. This is a quote that came from the Beaver Creek Conference a couple of weeks ago when he was on a panel with Joe Foster, who runs Van Eck's actively managed gold funds, and also Steve Toderick from Sprott was on the panel, and Joe Mazumdar hosted. And so Resource Capital Funds has multi-billion dollars. I think they have 7 funds under management, billion apiece, so 5 to 7 billion, we'll call it. And he says, what I would generally say is that the market has been bad for many years. We think we're coming out of that, and it's a good time to be deploying capital. Maybe not a great time to be harvesting capital. We are prioritizing gold as an investment space. That's the smart, big billion-dollar money saying that. And there's more contrarian factors at play. Consider that last year, $750 billion of private equity was raised around the world. $750 billion. How much of that went into gold? Just $3 billion. And in the past, call it 7 years, since gold had a nice run after the 2008 crash, the assets under management of institutional money, I'm talking just in the gold space now, has gone from $54 billion down to $32 billion. So no investment, lack of investment, not just in the equity markets, but as we'll talk about in a second, a lack of investment by big gold companies to invest in exploration and development and where their next round of deposits and reserves are going to come from. And so all this is the fruit ripening on the tree, right? It's coming. Next slide is very text heavy. Again, I'm an anecdotal guy. I'm a market watcher guy. And so the headline on this article was, Russia buys a lot of gold and dumps a lot of U.S. treasuries. You really don't have to read the whole thing because that's what it says. In the past couple of months, they've dumped 84% of their U.S. government debt. 84% they dumped. And they increased their gold holdings by 37% to 76 billion. I just ripped this text from an article I found recently. And so you think about what other countries are doing, not just in the U.S. where we tend to be focused in the North American markets when we look at the price of gold in a U.S. dollar state of mind. But when you look at it from the perspective of other countries, from Russia, from Brazil, from Venezuela, from Turkey, from South Africa, the gold price is actually ascending, right? And while their currencies are getting pounded, here you have emerging market currency declines, 50% for the peso, a third for the Turkish lira, et cetera, et cetera, et cetera. And while the dollar is still relatively strong, and I would probably argue could continue to be for a while because it's the cleanest dirty shirt, gold very much in the rest of the world is bullish. Here's text from a Sprout article that came out a week or so ago. The article was called Brinksmanship, and it was talking about Fed policy and rates, which is something I don't dive too much into, but I thought I should read this for you. He says that the petrol, the fuel of the Trump tax cuts is what's fueling GDP growth right now, and the Fed is mistakenly interpreting that as, we should normalize policy. But he says during the next few months, we can expect asset markets to come to terms with grossly misplaced investor faith in the sustainability of the Fed's dual policy agenda of simultaneous rate hikes and balance sheet reduction. Well, that's word salad, but what he's saying is the Fed's out of bullets. Their balance sheet was five times bigger than it was in 2008, and while we've started to raise recently, I think we're going to have to come back if there's any sort of recession emerging in the United States. That's good for gold. Here's what I'm talking about. This is a major bank report out earlier this year about the lack of reinvestment by gold companies. So global gold production declined 1% since 2000, despite an 850% increase in CapEx during the 2000 to 2012 peak. And now, since then, CapEx has fallen 75%. So if you only get a 1% increase in gold production with an 850% increase in CapEx, what do you think you're going to get when there's a reduction of CapEx in the gold space? And so a fair question to ask is what I just did. Either production is going to fall or the price is CapEx is going to have to go up. How are we doing on time? Oh yeah, I'll get you guys out of here for lunch. So this is Agnico Eagle's Sean Boyd in the press just late last week. The article was about why there's going to be continued consolidation in M&A in the gold space, and he's saying what I've just been telling you, that there's too few high quality opportunities and there's way too many people that need them. Just look at the recent mergers that we've seen of Barrick and Randgold. And this is good for the market. So since they combined their companies, or they called it a combination of companies, they've increased the market cap by $1 billion. Just by announcing the merger, the market cap of the combined companies has gone up $1 billion since the announcement. And so the market likes this. The market says, ooh, here's a big, juicy gold company we can get excited about. And maybe not just the gold market, not just the people who typically invest in precious metals, but also the outside market. And that's what you need. You need gold to be back in the headlines. You need gold to be excited again. So people like downtown Josh Brown aren't saying, well, screw that pet rock, right? Because it's actually providing returns once again. And this is just a quick list of what you've seen in the headlines lately. Australia coming in and buying the Pogo mine, the Chinese buying up the Nevsun assets, Core taking out Northern Empire in Nevada, and Hecla and Klondex. And those are just outright acquisitions, but I also think we're seeing more and more strategic investments where majors are coming in and saying, hey, rather than, increasing our exploration budget and spending more of our own money, we're just going to take a piece of quality exploration at juniors and development companies and just let them be sort of our de facto exploration arm. And I've got a couple examples of that, but first some more text. This is from my partner, Gerardo Del Real. He wrote this in an editorial last week, and I thought it was pretty smart, so I stole it. And he says, it's clear that mid-tiers and majors will continue to defer exploration expenditures by taking strategic positions in junior explorers as opposed to increasing their own exploration budgets. It's cheaper, there's less red tape, and the quality juniors tend to have a better pulse for local politics. And we've seen this in some companies that I follow and some companies that I'll talk about for the next couple of minutes. We saw Barrick come in and take 19.9% of Midas Gold earlier this year at a significant premium now to what the stock is currently trading. I think they were up around $1, and the stock is now 67 cents. And so you can buy cheaper than Barrick. There's been some setbacks with the permitting process with the giant stibnite gold project in Idaho, but nothing that's going to derail the permitting, I don't think. I think we still get a mine here, and further I would talk more about Barrick wanting to buy out the rest of the asset for some things that get technically complicated, but basically they need some high sulfur ore to keep the mills going in some of their Nevada operations. And if you draw a sort of 100-mile or 200-mile radius around where their Barrick operations are, Midas fits in there very nicely, and I truly believe they would like to have that stibnite ore from Midas. So Midas is one of my top picks in the gold space. MAX on the TSX, MDRPF in the United States. And then Revival Gold, they're also in Idaho. This is, and both of these, Midas and Revival, are brownfield sites. So they were both mines before. So we're just exploring them and developing them with new technology to make them their economic once again. So Revival has a former Yamana mine where all the infrastructure is built. The pad is there. There's actually ore sitting on the pad still. Revival was able to get it for a song from Yamana, and it's being run by a gentleman named Hugh Agro, who is formerly from Kinross. They've got a 2 million ounce resource, and they're working on increasing that to probably a 3 million ounce target. It's exciting times for Revival, I think, quite undervalued, and actually getting whacked in the market today for some other things that go on behind the scenes. There was another company that owned a position in Revival that is short on cash, so they have to dump their Revival position. So RVG is actually down 10% this morning, last time I checked. RVLGF in the United States. And then Almaden Minerals, who Newcrest came in and took a piece of last year, I believe it was. This is a fantastic deposit, the Ixtaca deposit in Mexico. It's 4 million ounces, about 50-50 equally, silver and gold. What's fascinating about this is that it's going to be a mine. I mean, they're working on their feasibility study now. It's supposed to be out, I believe, by the end of the year. And they purchased a mill recently, and they're moving the mill from where they purchased it in Alaska down to Mexico. The mill was in operation for 3 weeks, and as Morgan Poliquin likes to say, it was cryogenically frozen up in Alaska. Now they're taking it apart in pieces and shipping it down to Mexico, and all this to say that mill, if you were to buy it today, costs $70 million, which is the current market cap of Almaden Minerals, which makes absolutely no sense. The gold and silver is getting no value. And then just a long shot I'll put up there is Palomino. This is really early days in the Puno district of Peru. There's visible gold. He's put out some trenching samples of over 600 grams per ton. He's working on bringing in a strategic. There's ground truthing that has been going on for a long time from artisanal miners, and I think it's just one to watch and put on your radar. It's PA. You guys want to get to lunch. Thank you very much for coming. I'm Nick Hodge. I have one more thing going on today at 2:20. I'll be hosting a uranium panel, actually, I think right in this room. And if you want to find out more about what I do or the letters I offer, you can go to outsiderclub.com, sign up for the free daily e-letters, same at resource.digest.com. You can go there and sign up for our weekly update where we can consolidate all the news from the companies we follow in one nice email for you. Happy to answer questions on the side, and if not, enjoy your lunch. Thank you.